On June 28, 2026, the Bank for International Settlements, the literal central bank of central banks in Basel, released its flagship annual economic report. And they didn't mince words. The BIS formally sounded the alarm on what they are calling an unprecedented excessive exuberance in AI capital expenditure. They explicitly warned that the current trillion-dollar infrastructure spending spree is outstripping real returns. They uncovered a hidden web of high-leverage corporate bond issuance, obscured private debt, and complex supply chain circularity that echoes the worst days of the 1990s dot-com bubble. Specifically, the BIS referenced the 19th century railway mania, a period where speculative capital flooded infrastructure that far exceeded the immediate economic utility, creating a structural debt trap. If these actual returns fall short, the BIS warns we are looking at a sudden contraction in financing that could trigger a global financial crisis and a protracted economic slump. My name is Newell. Welcome back to the Signal and Noise podcast. Before we dissect the structural cracks forming beneath the tech ecosystem, take a quick second to hit that like and subscribe button to keep your capital insulated from the mainstream media's blind spots. Today, we deliver a raw diagnostic breakdown on the trillion-dollar AI capex cliff. We are going to analyze the exact mathematics behind the BIS's macro warning, expose the hidden non-bank leverage funding the data center boom, and chart exactly how to protect your portfolio. Let's dive in. Let's strip away the philosophical marketing pitches and look directly at the cold, hard macroeconomic data published by the BIS today. For the past 2 years, the global economy has been buoyed by an almost religious belief that generative AI would instantly spark a massive wave of post-war style productivity gains. But the central bankers just delivered a devastating reality check to that thesis. According to the BIS, the world's 5 largest hyperscale cloud computing companies are on a $1 trillion spend. Specifically, between 2025 and the end of this year, these firms are on track to spend an aggregate of more than $1 trillion. This is capital that has yet to see a corresponding revenue stream. The core structural failure, the mathematical lie at the heart of the boom, is the widening asymmetric gap between this massive infrastructure spending and actual verified commercial revenue. The BIS warns that financial markets are characterized by stretched valuations. The moment downstream software enterprise revenues predictably miss these hyperinflated expectations, the rails will snap. The sudden financing, snap. Institutional investors will swiftly tighten financing rails. This isn't just a tech sector correction, it's a structural realignment that could paralyze the entire investment landscape. The slump execution. Disappointing returns could trigger a sudden contraction in financing, turning a boom in capital spending into a prolonged investment slump with global spillover effects. The central banks aren't saying AI is fake technology. They are pointing out that even genuine breakthroughs, like the canal mania of the 1830s, attract an excessive influx of speculative capital that eventually collapses. In the 1840s, thousands of miles of railway were built that didn't turn a profit for decades. The debt used to build them, however, was very real and led to a systemic banking crisis. History is repeating in the data center. The physics of cash flow always reclaims the tape. Now let's move to the secondary, more insidious risk: the weaponization of the non-bank financial perimeter to mass corporate debt. Mainstream financial networks will tell you tech companies have pristine balance sheets, but that ignores how the modern AI infrastructure stack is actually being financed through shadow networks. Advanced AI infrastructure has aggressively migrated outside traditional banking into highly leveraged shadow banking networks, including private credit funds that operate with minimal oversight. Tech firms are using corporate bonds to fund data centers, which are then leased back to startups. These startups are often funded by the tech giant's own venture arm. It's a closed-loop system of debt. It's a leverage machine disguised as a technological flywheel. On paper, a tech giant looks like it's generating high-margin SaaS revenues. In reality, it is acting as a highly exposed commercial landlord. The moment a macro shock hits, like inflationary pressures from Middle East trade disruptions in the Strait of Hormuz, the cost of servicing this hidden debt spikes dramatically. The trigger points are everywhere. When the BIS explicitly warns that these exposures could unwind abruptly, you are no longer dealing with a normal cycle. You are dealing with structural fragility that the market has completely ignored. This brings us to the ultimate macro conclusion of the BIS report. The AI bubble isn't popping in a vacuum. It is hitting a wall at the exact moment that global governments are facing record-high public debt. Central banks are trapped. Geopolitical conflicts and supply shocks have ingrained higher inflation expectations. They cannot simply cut interest rates to rescue tech without risking a hyperinflationary spiral. At the same time, near-record public debt has left global governments with virtually zero fiscal room to respond to a new recession. There is no bailout coming this time. The BIS notes a dangerous sovereign financial stability nexus. If the AI boom reverses, the shock transmits directly into sovereign bond markets, crushing consumer demand across the entire world economy. The noise, the tech market is indestructible. The signal, the central bank of central banks has diagnosed a hyper-leveraged bubble that poses an existential threat to global stability. The revenue simply isn't there. What is the professional playbook? First, ruthlessly clean up your liquidity exposure. If your capital is sitting in hyper-extended tech equities that rely on shadow debt, you need to de-risk before the rails snap. Second, position your capital around robust, tangible fundamentals. As the central banks tighten the perimeter, capital is going to flee back towards sovereign, cash-flowing, non-circular assets. The math has reclaimed the board. Understand the plumbing, or remain the liquidity. Stay sharp, stay focused. Smash that like and subscribe button. This is not financial advice. Do your own research. We'll see you on the next block.